Alright, so just continuing on the course, we were over here, so I'll just go over this up move here. So basically you had an oversold condition here, a climax here, right here where the volume surpasses about 3 million. Then you had a rally, it had follow through, and you had three high lows. Pull back on low volume, reverses, goes up, not a lot of speed, actual dullness, especially right here, and that leads to this test right back to support, but it's on low volume, indicating there's no pressure, and there's a breakout after it on increasing volume that has follow through, but that follow through is just way too much volume. I mean, look at this bar and then look at this bar. How can you have 3 times the volume? It just doesn't make sense on a bar that's actually smaller than the bar before it. And the reason is it's climactic. And after that, this volume is there. After that, you have even more volume, and this is even worse because it reaches over 4 million, and after that has an immediate red bar. What is this telling you? It's telling you there's selling on the way up and selling on the way down. Otherwise, if this was all buying, you should at least hold. But it doesn't hold the close, and there's a red bar after it. After that, you have two or three bars that are just some extra, and volume is diminishing. It just takes out the high over here, catches any folks that want to buy the break or whatever. Notice that it's not really a breakout. It's not. The volume doesn't increase. Has no follow through. It's kind of like an up thrust across a level. After that, you had this right here. It's like one green bar, one red bar, one green bar, one red bar. This volume really bad, shrinks. Smallest volume in about 12 bars. Very dull, very bad. Market is hinging. This is what first time Wyckoff calls a hinge. Alright. And he says the market is saturated over here. So the first time he used the word hinge. I'll be going into that later. After that is a breakdown. There's a markdown bar. After that is where we're at. So this is June, July 8th, I think. Alright, a 2-point further loss on July 8th, a small rally on 1.5 million. Right there, during the 9th and 10th, back to the June 19th low. So all he's saying is right here, this right here is just tagging this low. This is the June 19th low, so it just rallies and tags it. Then a drop off until on the 15th, the average nearly touches 126. So it goes down to one right here. That's the 15th, and where is this? 120. I don't know, around here somewhere. It cracks 120 on increasing volume. Alright, 19-point decline. On this day, the spread over 4 points from high to low and closed slightly above the middle of the 4-point range on a 2.6 million minor selling climax. There's no follow through on the downside the next day because it's a green bar. Instead of quick rally and high close, we does have two indications that might lead to a rally. Alright, what are the two indications? The first is the selling climax, the minor selling climax. Again, the term minor, he's qualifying the type of climax it is. Second is immediate rally after it. So meaning the immediate high and close after it. Green bar. Okay. Thus we have two indications which might lead to the rally. I just went over those two indications, being the climax and the green bar after it. But that will be normal after 19-point decline. So after 19-point decline, market gets oversold, hits levels, you're going to get a bounce. The bounce amounts to about 7 or 8, but you can expect about a halfway back move. And on the 70 and 21st, and amounts to 9 points, thus offering a good level if you're not satisfied by your shorts. So you can just short it. It just goes up right here. You say you're ready to short. Yeah, this is pretty bad. What happened? I don't know what happened. Why is it bad? The volume is dipping, 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 and it's in that zone. Obviously gonna short it. So 17th to 21st. Again, I can barely see this, so just bear with me. The point is 17 to the 21. So from here to here, the 17 21 and amounts to 9 points. That's offering another selling. If you're not ready, short some more. Now the rally is over. For the 22nd, prices drop off after apparently reaching the lower edge of the recent supply zone. What zone? Just lower edge of this zone. Alright, and pop. After apparently reaching the lower edge of the supply zone of 137. So 137 should be around here. Okay. A second time. The first was on July 10th. So July 10th was here. That bounced here. This is your zone. Supply zones. That test 1. Here test 2. Not really test, but you get the idea. It's just, it tags the zones. Where we want to see if any real support appears. It does not. The average goes to about 122.5, recovers and makes a new low on August 10th. Alright. What the hell? August 10th. Trying to figure out where I am. This is July. It's the July 20. It's around here. Can't really read this. 17, 18, it's probably 20th. Okay. So now the rally is over. For on the 22nd. The price will drop again after apparently reaching the lower edge of the zone. The first was on the 10th and proceed to the former low of 126, where we want to see if any real support appears. It does not. The average goes about 122.5, recovers slightly to make a new low. August 10th around 120. 120. August 10th, right there. Recover slightly, rallies 10 points after dipping briefly on the briefly to the June 9th support point. The June 9th support point. So this was 115, 16, 17. So it's around 117. June 9th. Somewhere around here. Right? So the market tags this low. This low, the market is now at that same low around here. So the thing is, you have to know your support points, because they have a tendency to rally. This is what's going on here. Dies at the top. Goes right back down. Narrowly recovers weekly and on small volume. Critical support level until again, this is just the critical support level, so it goes there until 28th and 29th, where it begins a new down move on a very sharp angle. Alright, 28th or 29th. So all he's saying is this: market goes to a low, just mark your charts, goes to that low, rallies, reverses, goes down, tags that area, but this time when it rallies from that same low area, the volume is very bad. Very bad. That's why it recovers weekly on small volume from this critical level when it begins a new downward march at a very sharp angle. There's your downward march. Ding, 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 ding. The volume rises to about 2 million and it stays fairly constant at that figure after breaking through 120's snow, showing that the liquidation is again very heavy. How do you know the liquidation is heavy? Well, look at the latter part of August. The volume is low. Look at now the front part of September. Volume is almost double. It's it's much higher, and the price movement is confirming. No change to our short position, but plenty of reason pyramid. Wow, beginning on September 18, the volume increases 3 million shares. Alright, so it goes all the way here, right here. And on the 19th to nearly 5 million. This great increase in volume from less than 1 million to the equivalent of 5 million shares on September 18th is our warning. Meaning it's a significant increase from 1 to 5. It's like 5 times much. And to move stops, because to look out for a sharp rally or turning point. Prices have receded from 145 to 98 without interruption. That creates oversold condition. So you see it goes low, 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 low. If your stops were right above the high of the bar, it won't get tagged. It just keeps on going down. The abrupt extension of the decline plus the unusual high volume of the 19th suggests that the market has reached an oversold. Okay, there you go. Alright. A sharp rebound should not surprise us, and how it probably is, we don't know how it's going to happen. Alright, and no rally of any size since August 29th. I don't know what the fuck he's talking about. This is over here, this weak rally, and straight down movement. Seldom does the market run continuously in one direction for so long without reversal of some sort. When it does, it creates oversold, especially when it accelerates. September 20. Okay, let me just go to the footnote here. Whatever. Yeah, that's right there is dangerous. September 21st, but recovers 5 points. It goes down a lot, recovers 5. By closing time, and makes its close above the previous day. Volume is 4.4. Obviously, again, unusually high and almost equal to the day before. It's much more than the day before. This action combined with the 8-point spread in price for the day and the slight, the close is almost the same as the day before. That's what we're talking about. Slight close leads us to cover our shorts with a view of putting them out again on a further rally, or we may sit tight. On the 22nd, the volume dips to 22nd. It dips to 2 million. The close is slightly lower and the range has narrowed. The net result of these 3 sessions is to leave the market practically unchanged for third day's close. Downward progress seems to have been checked, and the small volume on the dip implies selling pressure is not there. After such a great decline within 3 weeks, this is an indication of more rally. So this is what you're going to get, more rally. And you got just 1 day wonder over here. After the great decline, 3 weeks, this is indication of more rally. This comes on the 23rd and gives us the opportunity to sell short again, while the market is still strong, and or when we see the rallies failing. I mean, you have to. He's saying all of this, but all you need to do is just look at the levels, look at the volume, look at the breakdowns, mark them, see how price went, go to lower time frame, see if the turning point is there, evidences of shortening of the thrust, change of behavior, feathers weight, LPSY, whatever, and then a reversal. And that's when you short. You don't just short on a bar like this, right? Because there's too much juice over here. So you don't know. When you see this over here on increasing volume, it can go all the way back to this area or this area. So would you short this? No. Why? Too much risk. So if you want to short it, you have to go to lower time frame and play the game there. So such an indication is given by the way it rallies on the 23rd. On the day, the average recovers to nearly 107, closing at 105, but the volume fell down, and we therefore suspect that its rally may be due to shorts who are trying to cover all at once. Such a rally is too effervescent. It is not likely to last because it removes buying power which formerly existed, and leaves the market without support between the high and of the rally and the previous low. So this is another description, an effervescent rally. The way I see it, you have a low, you rally from the low because of short covering, and immediately no follow through, and that's basically a short covering rally. Because it's unable to follow through. It's usually short covering is very swift. That's the thing. It's not prolonged because just they're in a hurry. The market acts the way on the 24th, and it loses 8.5 points from the previous day's close and ends 3 points from the extreme low. The constant volume compared with the previous day plus the rapidity with which the average yields nearly all the previous confirms the fucked up character of the rally and the lack of important demand. All he's saying is it tried to rally, and look at this. Would you consider this bullish or bearish? No, it's obviously bearish. Attempt to rally, tag this area, and reverse. Bang. Done. So bad quality of demand. Why? It lasted a day. That's why. After that, you had a bigger bar, as much volume or if not more, and a close took out the low. We conclude the market's inability to list worthwhile support and its tendency seek to lower probably include fresh outpouring of liquidation. That's what happens. You see that 95 is not going to hold. It's saying that if your rally is really weak, as indicated by immediate reversal, that support level is not going to hold. So at that, when you trade, there's all these damn levels, right? And how do you know when one's going to hold and one's not going to hold? One factor is the strength of the rally. Like if it's support and it's rallying, trying to rally from support is very weak, that's going to encourage the bears to come right back down and break right through. And it doesn't mean that you just need a big bar. Well, if you have a big bar, it better have follow through. If it doesn't, there's a big problem. We conclude that the market's inability, blah, 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 blah. The situation is still critical on the 26th and 27th, when a brief one-day rally and dips back to 95 bring about a slab-sided or downward slanting formation, judged by the tops of the 23rd to the 28th. Alright, so what happened? You have a very sharp rally down. Ding. So, bottom line, be wary when the moves are sharp like that. Anytime the moves accelerate, they'll turn all the indicators, they'll turn whatever, or is oversold, and people will buy it. Especially if it goes to a support level and it's oversold. Sheesh, they're ready to buy the bounce right there. So what is all this other shit saying here? It's the same point. The low close suggests lower prices the following session. He's saying if you have a low close, chances are the next day's close isn't going to be a reversal. I mean, that's usually true. But the market fails to confirm the expectation, thereby giving us additional warning of a change, suggesting this of sagging. It opens slightly higher on the 6th and then advances all day. Alright, the recovery of this average is about 11 points a day, the most aggressive rebound since a long decline from 145 started. All he's saying is, yeah, it goes down, but look at this, right back up. So right now, what's going on in your mind if you're looking at this market? In my mind, the market accelerated down. It's already susceptible to short covering. When I see a bar like this, immediately I want to take a look at the range and the volume. The volume is extremely high, and probably the second highest on the chart. So can it be a change of behavior? Well, first I want to confirm it's not any type of short covering. So right there you have a red bar. I'm not a fan of that because that's telling me bad, but again, the 3 points, high, low, and close, and higher, high, higher, low, both of those are there. Following day, okay, now it's not, I consider this to be all follow through. All follow through. Why? Because it's going to be part of one wave, that change of behavior wave. Even though it's a red bar, immediately followed that by a green bar and another green bar. So it'll be part of one wave, and that wave will have very heavy volume. Heavy increase in volume, emphasizing change. We are not watching the tape. Or if we had a wave chart show us the tape reveal, other charts give us no indication of reversal, we must cover our shorts. We realize the average has declined from here to here. We cannot expect the bear market to go forever. And now finally breaks the downward angle. So if I had a line from here to here, right here it cracks. 800,000. Here it gets dull. It's indication the sign of a reaction. From what we have learned by a preceding study of this chart, here's a point. From what we have learned by our preceding study of this chart, we recognize this indication as a sign of a reaction. What indication is telling you as a sign of a reaction? Volume falls off to very low. That is telling you there's a reaction coming. Now a lot of folks will say this is inside bar, outside bar, whatever. Yeah, it's inside bar, but look at the dip. There's a reaction coming. From what we have learned by our preceding study, we recognize this indication as a sign of a reaction, which comes in the next 2 days when the average recedes to 88, a point above the halfway back point. Alright, so what are some indications that a reaction is coming? One is this. So we just take a look at, over here, it goes to a support point. Obviously, support is where you have a lot of reversals. right? So you got to be careful about that. Second, here the volume dips under 1 million. That's very bad, right above here. So it's ready to fall. That low volume turning point. Low volume turning point. Then over here is a high volume, and it leads to a short covering rally, and there's a reversal. Here, I have to say accelerated price movement, high volume, and the reversal comes on the next bar. Here, I can't really tell. Here, on this bar, the volume dips. So it's very bad. So you see, like, typically high volume, as in minor climaxes, and very low volume. Both can cause reversals. Comes back, comparatively light volume. What do you know? We decide. It's come back to support on what? Low volume. What do you think is going to happen? I mean, I'm going to go into the study. Obviously, goes down. Lack of pressure is going to rally. A wave chart would tell us more. That's what he's saying here. Where is this? I'll go into that later. It will be completing a secondary reaction. So let's read this. So over here, the market dips back on support of October 7th. So this is the 7th. This is its dip back to the 7th. And on 8th, on comparatively light volume, much less than on. Over here, look at the volume, 3 million. Here, 1.5. We decide that if it is able to hold at this level or above, the first and second it will be completing a secondary test or secondary reaction, which would confirm the action of the fifth as a shakeout. Thus, the market seems to be forming the outlines of a support zone with low points of September 50th, probably the 5th, to October something as its probable base. Okay, accordingly, watch for opportunities to establish long trading commitments with the idea that we may be able to make a play for a further recovery, provided we can secure the proper limitations of risk. We do not take an investment, however, because we should like to see a period of dullness in preparation for a real bull market, which normally occurs after such a decline. Look at this. He wants to see a period of dullness. You know what that is? That means a lot of bars on the pullback that's not doing nothing. He wants to see that base form. He wants to see a period of dullness. We do not take an investment position, however. Why? Why does he not? What is his reasoning? Because we want to see a period of dullness in preparation for a real bull market. Normally after this type of, decline should begin at this level. To say positively that it will begin would be a pure guess. The market will tell us when to take the long investment. On the 15th, after rallying to the previous day's high, the average reacts but on decrease in volume. Okay, on the 15th is here. Okay, the average reacts by decrease in volume. Higher close, higher low tend to confirm this as a secondary reaction from the October 9th rally top, however giving the cue to venture trading purchases. Accordingly, we now buy the few stocks we have selected for the purpose. etc., etc. Diminishing volume on the rally of the 17th and 19th, followed by climax indication next 2 days. As the average reaches a resistance point, all tell us that a pullback is coming. Alright, long story short, this is bullish. Ding, 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 ding. Alright, this pullback is bullish. Why? Low volume. This rally is not bullish. Why? Also low volume. Here, definitely not bullish. Why? At resistance, increase in volume, which is sudden. Possible minor buying climax, as indicated by the reversal afterward. Okay? So, it's just going to pull back a little bit. Swings to dead center, coming to an apex. What the hell? Okay, so this is his apex. Right there. And again, you see that low volume right there? This is not good. Buying power exhausted by the recovery. Not willing to follow price upward. No increase in volume. All bearish. Doesn't know what's happening, up or down. On October 28th, the volume gives minor climax indication after the average has settled down to former support. Okay? With no increase in volume on the way down. We conclude that there is no further liquidation to worry about, and support is again coming in at this level. Right there. There's the level, support is coming in. This is confirmed by decreasing volume and no net change in the closing price following a further recession the next day. Recession just means another low. The zone of support has broadened. All he's saying is this low to this low is broad now for a substantial recovery, but you don't know. This is just a guesstimate. So on the 30th, we buy again for trading purposes, this time placing stop or whatever. The average then records a series of rising supports and daily higher tops and moderate volume until the 9th. So what's he talking about? Right here, ding, 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 ding. Keeps on going until here. This I possibly breakout over here. And then climax is right there. This tells us to get out of our long trades and go short. Supply is overcoming demand as the average reaches these lines of support and resistance. At the point where our chart ends, it appears first glance that we are getting a reaction on suddenly diminishing volume. Pull back here, which if the market has not exhausted the force of demand stored up around September, October lows, should encourage another rally effort. So all he's saying is they have a climax up here, pull back some low volume, so they should get another attempt. But it doesn't happen. And here's another point. These rules, they don't work. You cannot put rules on the market. This is why it is foolish to seek mechanical shortcuts or to draw fantastic diagrams and charts. This is telling you mechanical shortcuts, and basically he's blasting technical analysis right here. The fantastic diagrams are patterns, those bullish and bearish patterns. He's saying they're bullshit. And a rule of thumb procedure, meaning step 1, step 2, step 3. You know that process? That going through that process, I mean, yeah, you should have a process, right? But what he's saying is that just trying to rely on that process, and that reducing it to like, the moving average is crossed, that type of thing. It is foolish to seek mechanical shortcuts, meaning the moving average is crossed, and to draw patterns on the chart, because markets are not that simple. Alright, I think I'm done with this study. Again, I'm going to try to explain it. So here, price accelerated. Here, market rallied. Here, it had follow through, so it's ready for it. That's a change of behavior. This for sure is your change of behavior. And it pulls back. Right here, you're getting ready for a reversal. Why? Very low volume. Sets up, also low volume on the pullback. What is that telling you? It's going to try to rally again. Comes back again, goes to the performance support level. If you take a look at this volume, this volume is higher than this volume. So this secondary reaction is past. It's telling you it's going to rally. It does rally, goes up to here, not good, weak rally, and right here is a weak rally, and climaxes right over there into resistance. Then it pulls back, and also this volume does not look that great. And finally go on the pullback volume right here, ding 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 ding. So over here it forms a dead center. We'll get into the apexes, and market goes down again, not a lot of volume. Over here he says there's some type of minor climax, ding, greater, right around here somewhere near the support level, and then it rallies, and this again he's saying is a climax right up there. I find that a little bit tough to just say it's a climax. Why? Because if you take a look at this, it's a higher high, higher low before it, and it breaks. So I mean, I would expect more volume. Let me see. Here's where the volume should have came in. The next bar actually has more volume. Yep, because it's hitting that resistance area. So sellers are obviously low right here, and they're selling it. If it was the bar before it, it could be considered breakout volume. You see, like across these highs, so absorbing the resistance, but it actually came on this bar and had an immediate reversal. So that's why he's saying it's a climax. And finally, I don't have any more data, so a lot of other shit happens. But point is, the key behaviors here are here, this high volume change of behavior, here on low volume pullback, here tags resistance on a climax. All it does is moves prices back to the low, tests support, and goes up here, terminates again on a climax. Why is this a climax? It would have been breakout, but it's above the other highs. The breakout bar is here, not here. This is a climactic move. It goes into this resistance area and has immediate reversal. And then after that, I really don't have any data. So anyway, long story short, all of this it's all coming down to all that back and forth trying to interpret the market. And about that, he comes down to this really important point, that if you get nothing else, is you can't just use a rule of thumb, like if this average crosses that average, bullish. And and patterns also are very questionable. So that's all, folks. Where's my mouse? Lose that shit again.